The Federal Reserve held interest rates steady for the third consecutive time, laying the groundwork for highly anticipated multiple cuts in 2024. Now, those cuts would bring the Fed's target interest rate closer to 4.6%. Our economic correspondent Shin Ha-young reports.
During the U.S. Fed's last meeting of this year, policymakers on the Federal Open Market Committee decided to maintain interest rates for the third consecutive time. With the Fed's latest move, the benchmark interest rates in the U.S. now stand in the range of 5.25% to 5.5%, marking a 22-year high. The decision is largely attributed to robust employment and a slowdown in inflation. The Consumer Price Index, a key gauge of inflation, for last month rose 3.1% on-year, the lowest increase since June due to a drop in energy prices. Consumer prices have been slowing after hitting 9.1% in June of last year. The U.S. has been grappling with inflation, leading to a series of rate hikes over the last year and a half. On Wednesday, Fed Chairman Jerome Powell acknowledged that the current level is likely at its peak, but emphasized that it's far too early to declare victory.
While we believe that our policy rate is likely at or near its peak for this tightening cycle, the economy has surprised forecasters in many ways since the pandemic. Ongoing progress toward our 2% inflation objective is not assured.
The central bank has revised down its economic growth estimate for next year to 1.4% and also lowered the inflation rate to 2.4%. The interest rate is expected to tick down to 4.6% next year, hinting that the Fed may cut the rate by 1/4 of a percentage point 3 times in 2024. Following the Fed's announcement, U.S. stocks welcomed the news. The Dow Jones Industrial Average on Wednesday surged 1.4%, closing at a new record high. The S&P 500 rose by 1.37%, while the Nasdaq closed with a 1.38% gain. Meanwhile, the latest Fed rate freeze means the key interest rate gap between South Korea and the U.S. remains at 2 percentage points. Shin Ha-young, 아리랑뉴스.